Welcome to this Leap Day Key Trades, Monday 29th of February. We're watching sterling against the US dollar looking at lows not seen since March 2009. Oil, meanwhile, after big gains last week, analysts are saying that the market is now pondering a base price. And gold, as other markets decide on where they're going, the gold bugs continue to support the metal above 1,220. But first of all, to sterling. Now, this time last week, we were all talking about the Brexit fears. Today, of course, they remain, as indeed will be the case until the 23rd of June, when that referendum hits us. But today, we're hitting new 7-year lows for sterling against the US dollar. Here's Alastair McCaig with a look at just where it's going from here.
Yes, conversations about Brexit are going to continue for some considerable time, the best part of 4 months, so we better get used to it. Ian Duncan Smith from the Conservatives, the latest to voice his opinion about how we'd be better off out of the EU. We're going to get plenty of ebbs and flows, and I think it's probably prudent that we look towards maybe placing orders to work in the background, as we will get a fair amount of volatility that will emanate from the commentary coming out of politicians over the course of this time. Also worth remembering, of course, on Friday, non-farm payrolls, the other side of the equation. I've got a chart here, a 5-year chart on a weekly basis looking at cable. As Jeremy mentioned, obviously we're hitting lows not seen since March 2009, but I think ultimately the levels we'd be totally looking for would take us back to January 2009, around about 135.04, looking for opportunities to sell into this. We are oversold on the RSI already, and I think any sort of bounce taking us, as long as we weren't to break above 142.20, I think we would see as opportunities to sell into. Ultimately, from a technical point of view, we will look to go and retest those lows. Sell on a decent bounce.
Also in key trades over the last week or so, we've been monitoring this rise in the price of oil. It doesn't matter which oil barrel you're looking at, whether it's WTI or Brent or from wherever it comes from. It's been a good week overall, but the markets are now looking at just where it's going to go from this point on. This time last week, of course, there was a lot of news in the markets. At the moment, though, we're in a little bit of a lull. Again, off to Alastair.
Well, oil prices have been subdued for some considerable time, but they haven't really completely capitulated. And this is something we're maybe asking ourselves as to why. There are a few things in the background worth remembering. There is a lot of European exposure to the Middle East on the back of this through the financial sector, but also worth noting is the amount of sovereign debt that many of the Middle East countries have to repatriate towards the latter stages of 2016 and 2017. That might be the catalyst for a change in strategy. That doesn't really kick in until the second half of 2016, and until that happens, I think we still look to sell into the bounces. Take a look at the chart, and this is a 2-year chart of oil prices. I think that 100-day moving average, the blue line, is arguably the top end, 36.39 at this point in time, top end of the range. Any decent bounce up towards that level would be seen as an opportunity to sell into. And again, we'd be looking at this from a negative, bearish point of view. The fundamentals still massively outweighing everything else, which is massive oversupply. Oil inventories coming out on Wednesday as well, another key issue to keep our minds on.
One of the things about gold is that it continues to be a haven from some turmoil in the markets, but we haven't really had that turmoil now over the last week or so. But gold bugs continuing to trade or to hold on to gold at these levels. Let's go back now to Alastair to discuss just what the upside is now from here. So I know last week he was beginning to change his view on where gold is going.
I've been a long-term bear of gold ever since we hit those highs very close to 2000. I felt it was oversaturated, and the change in mindset in regards to interest rates had certainly been one of the catalysts to keep the pressure on the gold price. That being said, the timeline for US interest rate rises has obviously distanced itself. Therefore, the lack of income that gold offers is less of an issue. If we take a look at the chart, we can see this is a 5-year chart on a weekly basis, and the gold price has managed to break through some very bearish trend lines that it found very difficult to do over the last couple of years. So there is a different feel towards this. Also worth noting, we are overbought on the RSI. Unless we were to break below that 1192 level, I think we'd be still inclined to keep with our positive outlook towards gold. I think ultimately we will be looking at the 1300 level to be breached and breached.